Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending March 15, 2019. Well, it appears the bears are still in hibernation, but we are building up for an epic battle. More on that in a minute. We've seen global markets this past week all finish higher. I mean, the Dow is up about 1.6%. S&P up a whopping 2.9% for the week. NASDAQ even did better, up 3.8%. And the Russell bringing up the rear at about 2.1, but still slightly higher than the Dow. Meanwhile, in the U.S., the CBOE volatility index, the VIX, was down 19.8%. We actually closed the week in a 12 handle, 12.88. And not to be outdone, of course, we've seen the world markets, the FTSE, over in London was up 1.7%. The CAC 40 in France up 3.3%. The German DAX index up 2%, and the Nikkei over in Japan up 2%. And China was up 1.8%. So all in all, this past week, money flowed into the equity markets, but we're also seeing money flowing into the debt markets as well, which is really interesting. For the week here in the U.S., the sector performance, the best performing sector was technology, up about 4.18%. The worst performer was industrials. It was down. One of the few sectors that was down for the week, 1.07%. Excuse me. And the current PE ratio, the forward 12-month PE ratio, still relatively in line, about 16.4, 16.5. Last year is still higher at 18.5. So valuations are still down a little over 10% from this time a year ago. But what I talk about with an epic battle, really an amazing. For the past 12 months, the SPY, the S&P, is up about 4%, while the utility sector is up a whopping 20.3%. Huge outperformance in utilities during this same 12-month time frame. And it's really interesting because the debt market, traditionally when markets move higher, equity markets move higher, bonds move lower, and interest rates move higher. But we're getting this incongruency right now with bonds moving higher and thus interest rates lower, while equities also move higher. So typically the smart money is in the bond market. So what do the bond traders and investors in the credit markets see that the equity markets don't see? So like I said, underneath the surface, there's an epic battle going on, and there's going to be a winner and there's going to be a loser. And depending on which side of the equation you're trading, you're either going to feel the pain or you won't. But that's coming up, I suspect, over the next 90 days or so. We'll see this thing play out. Clearly, it's been building over time. The other thing, I saw it on one of the business channels Friday morning. I kind of laughed a little bit. We've got a new acronym now, TOSO, tired of sitting out, TOSO, which kind of then leads to FOMO, fear of missing out. So first you're tired. So you kind of edge in with one foot. And then as the markets keep going higher, then you got a fear of missing out even more. So you jump all in. So there's some elements of truth to that in human psychology. As the markets move higher, it tends to beget more people wanting to chase the markets higher. And everybody, including a lot of analysts, feel that besides Q1, with earnings going to be kicking off here officially in another few weeks, most analysts fear Q1 is going to be lower, but that's already factored in. And then they see a rebound in the Q2, Q3, Q4 timeframe with markets moving higher. Yet the bond markets and interest rates don't seem to bear that out. So this coming week, on Wednesday, we get our favorite central bank lead, Power Ranger, Boom Boom Powell. He's coming out with his U.S. economy and interest rate policy forecast. Of course, no one expects a rate hike. We're currently at about 2.25% to 2.5%. But the markets and most analysts are going to want to know what's coming up next. I mean, if you look at the Fed fund futures, if you'd have told me this 4 months ago, I wouldn't have believed you. But right now, there's a greater probability of a rate cut than a rate hike by this time next, or for the next out the end of the year into early January. Really crazy. And we're getting a lot of, in the political persuasion, we're getting a lot of people trying to promote the idea of a new modern monetary theory, which believes that you can print all the money you want as long as it's your money, and it shouldn't bear out in higher inflation, and it shouldn't affect the wage growth. So we're seeing a lot of MMT believers. They want to hear what the Feds have to say about it. And of course, Boom Boom Powell, he disagrees with that. And I do personally as well. But we're going to see how this plays out, because clearly after a little over 4 trillion in money printing over the past 10 years, it certainly hadn't done anything for rates. It's kind of moved rates down, and they've stayed down even with an equity market moving higher and inflation that we're seeing in asset prices. So at some point, all of this is going to play out. We're also seeing, this element of fear in the markets, and I heard someone else, which I think he accurately pointed it out, where the fear trade is actually higher, not lower, which I haven't seen in quite some time, because we certainly have a lot of fear still out there, which would probably give rise to a higher price action in the markets. Okay. I mean, we're seeing industrial output in China in the first 2 months of 2019. It's the slowest pace of expansion we've seen in China in about 17 years. But and then we've got the issues in Europe that I don't need to expand on right here. But this is kind of where we're sitting right now in the markets. What you see on the screen is the daily chart of the E-mini S&P 500 futures. You can see we kind of finished the Friday trade and the week on a strong rally. I mean, we actually opened the week down in these lows down here, and then we just came up very strong. And we made new 2019 highs in many different indexes, including the S&P 500 futures. You can see the high now for 2019 is 2836.50. And we're on this Elliott Wave 3 count, so we've got this 1, 2, 3, and that would suggest that, can we go a little bit higher? Sure. I don't see too much runway to the upside until we get more clarity on China, and we're hearing a lot of conflicting signals coming from the Trump administration. But just Trump being Trump, he's going to want this market to go higher. So I don't think, as most market participants think, he's going to screw up this China trade deal. They're going to come out with something. But the big key is, what is this something, and how is it going to affect price action? Remember, a lot of the price is already factored in, primarily for the trade tariffs coming off. And that'll goose the markets up and probably allow us to take out the 2018 all-time highs of 29.47. Should we get that kind of resolution here? Now it seems like that the possible meeting will be in April sometime, maybe early April. We'll see. But you can see on the EMAs that I'm using, the 50 has crossed the 200. We don't have that yet on the SMAs, but we're only a week or so away from the SMAs, simple moving averages of the 50 and the 200 crossing as well. And you can see they're crossing the MACD. So we're fairly strong here. You can also see this volume over price. I've got a value area here around 27.90. And we're now holding the 28.29 area. So for me, I'm going to want us to hold this 2800, okay? So if we look at it, if we can hold 2800, the longer we can hold it, the better it's going to be for the markets to just continue to rest a little bit and then continue to march higher. If we look at this same chart, but let me apply a 3 standard deviation Bollinger Band on it versus 2. I've shown this before. And if we look at it here, you can see the contraction of the Bollinger Bands. Now, the red line is 3 standard deviation. The purple line is the standard 2 standard deviation on a Bollinger Band. And then the blue line's a 1 standard deviation. And then the yellow line is the center of the Bollinger Band. So you can see this contraction right here, but I will remind everybody that contraction in Bollinger Bands leads to expansion, and expansions lead to contraction. So, and you can see over here in 2018 through the summer, we would have a small expansion and then a small contraction and then an expansion and then a contraction, expansion, contraction, expansion and contraction and so forth. So now we're back at this level here. Now I've also put on here fib nodes from the December 26th intraday lows to where we are right now, right? With the highs at 2836.50. And you can see a 23.6% pullback is sitting right around 2713. So as I'm telling our members, 2700 is our go-to level on any pullback. Okay. And who knows what would trigger a pullback, but I do believe we could get one set up here. And you can see we're right at the 2 standard div. If I were to blow this up, blow the chart up, again, it's a daily chart. You can see we've been tracing this 2 standard div, which is the purple line, all the way up, and we're sitting on it. And generally when we hit this purple line, we run sideways to coming back slightly below the blue, back in towards the yellow area, which is the center of the Bollinger Band. So if we go to the yellow, that would put us right down to about 2790, which is about 40 points south of where we are now. That would not surprise me at all. In fact, I would probably anticipate that, guys. You can see these bubbles here with the plot in the middle. That is a calculation using Gann and Fibonacci, and its best estimate sometime by second week in April or because Gann also is time-based, of around 2687.38. That would be the middle of the low to the high. So it just plots a middle area there. So that would take us slightly below our fib node, 236 fib node of 2713. But leaving us above the 38% pullback and the more popular 50% pullback, which I will remind you takes us down to 2576. So we haven't had, since we've blown off of this intraday low here, we've just been steadily staying north of the Bollinger Band, which is this yellow line. We dipped below slightly in that 1 week where we had a little bit of a pullback, right? And we dipped down to the 1 standard div down below, and now we're back up, but we're still in a contraction phase, okay? So this would kind of indicate to me that, we've still got some people chasing pricing to the upside, but you still want to be hedged. And now is a very inexpensive, cheap time to hedge to the downside. And I've shown our members here how to hedge in a portfolio margin account and how to hedge in a Reg T account. There's different ways to do it and different instruments that we use to hedge. The other one that I will show you, which we've been using for a while, let me just show you this chart. This is a, let's get over here. This is a Ichimoku chart on a daily, as you can see here, and I've got some lines drawn in. Ichimoku is calling for a support point around 2746, so let's call it 2750, and then a little bit lower here right at about 2688, which is right in line with the fib nodes that I pointed out on a previous chart. You can see the width of the cloud here, which is now green, which indicates we've got a huge wide support area, and it seems to indicate to me a wider consolidation zone in the markets. You can see this long period here on the MACD, and then the cross back up north of the zero line, which is bullish, which would kind of go along with what the Ichimoku is showing us here, okay? So we've still got a lot of support underneath. We are still in a buy the dip mode in the markets. Clearly we're in a buy the dip mode. I had our members switching over to a buy the dip mode probably mid-January. You can see when this red line crossed the blue line here, we switched over to a buy the dip mode, and we've been in that really ever since. We're airing to the bullish side. Keep in mind, longer term, I do believe we're going to get a 3 to 5% pullback, but we want to take advantage of the up move while the price action gives it to us. Okay, so that's a little bit about what I'm seeing at a high level. Now, if we come back to my original chart here that I kind of opened up with here, let's come in and take a look. You can see here the 50 is over the 200. Now, if I also look at the Dow, you can see the Dow, not 2019 new highs like in the E-minis, but again, we've got the 50 over the 200. We got a lot of support underneath. We've got a cross in the MACD above the 0 line. So we're seeing some strength here, not as much as the E-minis. And of course, if we look NASDAQ futures, you can see again on Friday, 2019 highs, 50 over the 200, cross above in the MACD. You can see the strength in the market, the value area in the futures going back about 3 months. Or 90 bars, but 3 months roughly on this chart is around the 69.26 area. So everything is pointing up. And then, of course, if we look at the Russell, this is one thing I want you guys to pay attention to. Notice in the Russell, we are seeing a little bit more weakness. We do have a cross in the MACD to the upside, but we're seeing weakness where we started showing weakness in the Russell right around the 25th of February. The Russell made the 2019 highs on the 25th of February. So let's just compare that to the E-minis. The E-minis made on the 25th of February, you can see here we made a high here, but the E-minis have moved up and made new highs, okay? The Russell did not. So I will point out that if we go back to the Russell futures again, and we come back before the crash, right? The Russell made highs on September the 4th, and then it started giving it up, okay? So you can see with the Russell, it made new highs September the 4th. It came down. It attempted to make another run the end of September, but it did not make new highs, and then we had a crash. Okay, so remember the September 4th time, because if we come in and look at the E-minis, and let's go back to September the 4th, you'll see here that on September the 4th, we were down here. So the E-minis made new highs on September 21st and then could not make new highs, but came right back up on October 3rd. And then it started falling down. And by October 3rd on the Russell futures, right? If we come in and look at October 3rd, right here, the Russell right in this area right here was way up here. So the Russell was already giving it up. So the Russell led the way down, and then on a relative performance basis, the Russell led the way up and peaked out earlier on the third week in February, whereas all the other indexes are now peaking out. So does this mean that the Russell, which typically leads the markets higher and lower, does this mean the high has been made and we're going to start making lower highs and rolling over, which will then pull the other indexes down, possibly not as severe as we saw in December of Q4 or even October, but still drag the markets down? We've got to watch this very closely. Notice on the Russell, the 50 has not crossed the 200 yet. We actually moved below the 200 EMA on early March. The 50 EMA held us up. You can see right over here, the 50 EMA was resistance and then became support. It's support now. If we go below the 50 EMA and slip below and don't recover, then it's going to be a little bit more dicey for the other indexes. So let's watch the Russell very closely and its relative performance, because it's small cap, mid cap, less affected by the international markets, but more affected by what's going on here in the US markets. We got to watch it very closely. And let's look at the VIX. Volatility now is in the green zone. We actually had a handle at 12.88 below 13. We're in the green zone on the VIX. That suggests different strategies. When we are in the green, we want to be hedging a little bit more because hedges are cheap now. All right, unlike up here when now you start thinking about hedging when the VIX is higher, they're very expensive to hedge your markets in your portfolio or hedge whatever you're trading. So we're looking at hedges. And remember, if you've got a Reg T account, which means you don't have portfolio margin, and believe me, if you've got portfolio margin, you would know it, because you've got to go through and ask permission to get it. It's not granted to you. I don't care how much money you've got in your account. You've got to ask for it, and you've got to take a test to get it. But once you get it, then it opens up a world of trades that you cannot do with Reg T. Okay, most people have Reg T, and depending on whether you've got Reg T or PM is how we hedge the account. All right, we cover that in our Option Master series. So for those of you that not are in our Option Masters, I highly encourage you to come and check it out. I'm going to be redoing our landing page video anyway, because we just updated our Option Masters and our learning management system. So I got to incorporate that. So you may want to check out our landing page after this video here. But anyway, this is where the VIX is. And then if we look at the front month term structure in the VIX, let's just get that on the screen here. We are, and it generally, the front month term structure, the closer we get to expiry, the closer it's going to move to zero. Why? Because the VIX is going to equal the vol futures. All right, so it tends to just wipe away as we move closer. So let's look at the back month term structure, which will pretty soon be the front month in another, week or so. You can see here we're well into a contango environment. All right, so in the green here means we've got a normal term structure, and every time we're in the green, as soon as we get the 200 EMAs over the 200 SMAs, let me say that again, guys. As soon as we get the 50 SMAs over the 200 SMAs, we're now in a negative roll yield with VXXB, and we're going to enter back into our vol trading strategies again, which worked really well for us last year. So this term structure, the back month, generates the roll yield in VXXB, and it's either positive or negative. If we're in a contango environment in the back month, then VXXB's got a negative roll yield, okay? If we're in the red, then VXX has a positive roll yield, and that determines how we trade it. So this is the term structure going out at least through March and April. We're in a normalized environment right now, okay? If we look at our treasuries and look at bonds, bonds finished strong on Friday. All right, look at this. It was up 25 ticks. And when bonds are up like this, what happens to interest rates? They come down. And if we look at our 10-year, interest rates fell over 3 basis points. We're coming down to my target, guys. Remember, I put this target out here of about 2.5, and we're coming right down. It's a 3-4-5 Elliott wave pattern. The Elliott wave 5 is going to put us right around the 2.5, and that suggests lower bond yields. So what in the world is the bond market and the debt market telling us that the equity market is missing? Remember, the credit markets drive the equity markets. It's not the other way around. So that is this big fight that we have going on underneath the surface right now of the markets, and we're going to watch this very closely. All right, this would tend to suggest we're going to get a little bit of a volatile time here coming up over the next few months. And it wouldn't surprise me because we're going to be going into earnings for Q2, and with that contraction of the Bollinger Band, it just seems to be setting up for expansion. And generally, the Bollinger Bands expand with markets moving lower, not higher, although I've seen it work that way. But with interest rates moving lower and the credit markets generally driving the equity markets, it would tend to suggest a little bit more of a pullback. If we look at our currencies here, the pound, which I've been following and telling everybody, the reason why the pound has been moving higher, volatile but higher highs, higher lows, is because the politicians in London are going to do what politicians do best, and that is just to kick the can down the road. So we've seen this Brexit. I call it a piece of toilet paper stuck to the bottom of your shoe, and you just can't get rid of the darn thing. Brexit just keeps resurfacing. They keep Theresa May, I give her a lot of credit. The poor woman is getting the hell beat out of her, and she keeps coming back for more, like a Monty Python movie. I think I've said this a couple of times. But the pound is moving higher on hopes that the hopium or optimism that they're just going to keep delaying this thing, and then they're going to give up and they're going to stay in the EU. I don't see that happening. I see eventually they're going to work their way out of this, and then we're going to see how the pound reacts. Okay, but that's what's going on right now. We're also seeing the dollar, which has been moving higher, right, coming back a little bit, even though interest rates are going higher. Remember, this is the dollar index, so this moves relative to the other market currencies, primarily the euro. And obviously, we're just nothing more than in a wide trading range in the dollar. That's all we're in right now. So I don't see much of a trade on this. Euro, you can see the euro down here. We're on this Elliott wave 5 down. That would suggest an ABC pattern here after an Elliott wave 5. You can see this 3, 4, 5 pattern with multiple 1, 2, 3, 4, 5 legs inside of this. It's very choppy, so we could be getting an ABC pattern here. There is almost no divergence here, so I just don't see the euro climbing much right now, and Europe's got a lot bigger problems than Brexit. So let's just kind of see how this thing plays itself out. We're going to get this week, in addition, on Wednesday, to Boom Boom Powell, Power Ranger Boom Boom Powell's U.S. Fed policy on Thursday. We're going to get the Bank of England. They're going to be announcing their monetary policy decision. So that should be really interesting because that's also going to affect the euro, I believe. So let's just see where this thing all winds up. Energy, oil. I've been saying the mid 50s for oil, not much higher. You're seeing here that we're running into this 200 EMA resistance. Oil is a strange fellow right now. We got a lot of geopolitical things going on. We got OPEC trying to cut production. They seem to be holding up production at about 800,000 barrels a day of production cut across all of OPEC. Venezuela, when they had the lights out this past week, that just stopped their oil, but a lot of their oil is not getting to the international markets. They got about 16 tankers full of oil sitting off the coast. And when Maduro leaves and Guaido takes over, then he's going to release a lot of oil. He's going to flood the oil markets because he needs money. And the U.S. is going to help him and be one of the first buyers, I am sure. So that's going to have a tendency to put downward pressure on oil. I think any upward pressure, I have said that if oil gets up into the high 50s, low 60s, I would be more willing to short it than go long oil because the shale production continues to outproduce. So in the near term, it's going to be choppy, but I see a range here of low 60s to low 50s over the next 12 months in WTI. Okay, so that's a little bit about what I'm seeing in the oil markets right now. And of course, if we go look at gold, gold is doing this very choppy mode here. This could be the formation of a handle on a cup and handle pattern. But I don't see a lot of upside in gold right now. It fell below the key level of 1300, and then we just recovered it on Friday to 1302. And we're sandwiched between a couple of value areas. So I think gold's got a ways to kind of work through here just to see what gold wants to be, right? And I think near term with inflation, pretty much zero, interest rates pretty much very low. Markets are chasing equities right now. So gold is not where I want to be short term. Okay. We're looking at other trades in the metals market that I think it's set up really well. Same thing in the ag market, right? And we got a couple of other things looking like they're playing themselves out, especially in the equity markets. So this is kind of where we're sitting right now through the end of the week, March 15th. For our members, I will see you this Sunday night for our weekly market watch for the upcoming week and some of the things that we're seeing. If you're not a member, I highly encourage you to come in and check us out. I think you'll enjoy it. All right, everybody, have a great weekend. Members, I'll see you this Sunday evening. Take care, folks. Ciao.